So, the US trade conflict with Mexico and Canada is temporarily suspended. According to the cynical definition of the US president, this happened after his friendly conversation with the Mexican leader Claudia Sheinbaum. As we expected yesterday, Donald Trump's executive orders on the tariffs were primarily aimed at forcing negotiations. The 30-day deadline was also set with this goal in mind. There is no doubt that this drama is far from over, and the sequel is inevitable. Meanwhile, experts have already pointed out that Trump's escalation of trade tensions could weaken the entire North American economy. Since the beginning of the week, several figures of policymakers have warned about rising uncertainty in the outlook for the U.S. economy. Atlanta Fed President Raphael Bostic stated that he wants to wait for some time before considering another interest rate cut. His colleague from the Chicago Fed, Austin Cosby, warned that differentiating signs of economic overheating from the temporary effect of a trade war will be extremely difficult. For this reason, the Fed Reserve may need to pause simply to assess the situation properly. A pause in rate cuts is generally good for strengthening the currency but can harm the economy. When the dust from the trade war settles, the economic situation could worsen significantly. If the high interest rates remain in place, they could slow down growth even further. For now, the latest tariff shock has been positive for the dollar's growth. The 10% tariffs against China, which were announced on February 1st, have officially come into effect today. In response, China has announced countermeasures. However, the White House has also announced an upcoming phone call between Washington and Beijing. It means that the uncertainty that markets hate is going on, widening heavily on risky assets. As the markets weigh to the US dollar index, which tracks the greenback's dynamic against the six major currencies, is consolidating within the range of 108.40 to 109.00. As for tariffs on the European Union, they are also on the horizon. I think they want to make a deal with us, Donald Trump commented during a White House press conference, adding, everybody wants that. So, the list of the candidates for a friendly conversation in a Trump's negotiation style, just like with Mexico, is quite long. However, his upbeat mood did not stop him from criticizing the European Union for its reluctance to allow American goods into its market. He also took a moment to threaten Denmark, just in case it's not ready to negotiate over Greenland. By the way, in the case of a full-scale global trade war, Goldman Sachs expects the euro to plunge by 8 or 10%. Meanwhile, Deutsche Bank predicts that the euro-dollar pair could fall to 0.98 or 0.99 even without a trade war. It's clear to everyone that the Eurozone economy is already limping and the ECB will continue cutting interest rates. And this means that the scenario of the euro falling to parity with the US dollar or even lower remains in play. Meanwhile, the ongoing trade standoff between the world's two largest economies, China and the United States, is clearly dampening risk sentiment and putting pressure on the euro. Today, the single currency remained near 3-week lows, trading within a channel along 1.0300. Meanwhile, the short-term technical outlook for the euro-dollar pair indicates a loss of a bullish momentum. In other words, after the suspension of the US tariffs against Canada and Mexico, Eurobulls lacked the energy to fully reverse the previous losses. When the instrument fails to move in the expected direction, a pullback becomes highly probable. For this reason, analysts suggest sticking to a selling strategy as long as the euro-dollar pair continues to move toward the support level at 1.0120 and parity. Today, oil prices are also sensitive to political decisions. Yesterday, OPEC and its allies held a summit and, as expected, maintained its agenda. In other words, the alliance ignored the US president's calls to help lower oil prices by increasing production. Besides, oil reacted to reduce supply risks from Canada. At the same time, the US-China trade standoff escalated. In response to Donald Trump's 10% tariffs, Beijing announced countermeasures, a 15% tariff on the US coal and the gas imports and a 10% tariff on crude oil. However, just like in the Eurozone, this conflict is unlikely to improve China's economic outlook, which automatically dents commodity demand. As a result, negative factors currently outweigh the positives. This led Brent crude to break below the key support level of 75, while maintaining bullish momentum within the range of 74.80 to 75.60 dollars per barrel. When it comes to the risk balance for the Russian ruble, it's likely to remain neutral in February, given that oil prices stayed high in December and January. They partly offset the decline in foreign exchange inflows caused by the anti-Russia sanctions. At the same time, February's import volumes are seasonally lower than the annual average, but higher than in January. As a result, the ruble continues to retain speculative appeal, while the dollar remains below the mark of 100. So that's all for today. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you!